For many people, buying their own home is an exhilarating experience. To be a part of the great Australian dream. To escape the rat race and cease having a landlord having it over you. But the problem I've encountered for many is that it's never been harder. When I look towards the headlines, news outlets like the Australian Financial Review seem to be flocking towards blaming Uber Eats, Afterpay and Netflix. But does your recreational spending really have that much of an impact on your home loan application? I feel like it's important to try to understand some of the bank's guidelines for deciding who gets a home loan, especially when considering that in December 2018, the DFA reported a 40% home loan rejection rate. So today I have a simple question. What factors affect the bank's decision in how much you can lend? Unfortunately, the answer to this question is not so simple. Home loan assessment by banks, lenders, and building societies depend on a number of contextual factors, including, but not limited to, income, expenditure, and security. So, instead of trying to understand which has the biggest impact, we're going to have a look at how certain factors change the outcome of a home loan application. The floor rate underpins every assessment. Also known as the assessment rate, it's an inflated figure used to assess whether or not you can afford the loan over its term. It has a massive impact on the amount you can lend. All else being equal, this one factor will change how much you can borrow. In recent times, the industry has called for the 7% floor rate at a minimum to be reduced. And what the calls were was a 2.5% buffer over the lending rate offered. So, if you were given a 4% interest rate, the assessment rate, rather than being 7%, should be 6.5%. Westpac actually recently did this and reduced their assessment rate to 6.5%. This was short-lived though. With only a day passing where they reduced it, they had to increase it back to 7.25% due to the industry regulators. The difference between these two assessment rates would be an additional $40,000 in lending capacity, from $500,000 with 6.5% versus $540,000 on a 7.25% floor rate. That's close to a 10% increase. When we look at your monthly living expenditures, we get some surprising figures. Let's take a couple living in Brisbane as an example. Each work a full-time job, earning $50,000 a year respectively. With this scenario, the lender would consider this couple spending a minimum on their everyday living expenses for essential costs such as groceries and insurance, ranging from $3,142 to over $4,500 per month. The difference has a material effect on how much you can borrow, with the lower allowing this couple to lend $509,000 and the latter $355,000. That's over $150,000 in difference. And whilst you might be a perennial saver, sticking to your budget and living under your means, the banks on the world differs severely. Even if you can prove that your everyday living expenses are lower than their benchmark, the higher of two is what's adopted, meaning what you can borrow and what you can afford are two different things. And things get pretty interesting when we switch our attention to look at income such as overtime, a source whereby you have control. And, as the saying goes, hard work pays off. But does it? For the most part, lending institutions accept 80 cents in the dollar, with the exceptions of a few adopting 100%. Taking a person with a base salary of $50,000 per annum and receiving or earning $20,000 per annum in overtime, the difference in lending capacity would be over $31,000, with both having the same floor rate and monthly living expenditure. So, with each bank differing their approach in adopting overtime at 80 cents in the dollar or 100%, there's a material change in how much this couple or this person can borrow. Ultimately, how much you can lend depends on a context of information. There's no one thing that impacts your ability, however, many different factors which all play a part to dictate just that. If you're in need of a guide, here's a tentative rule of thumb that can help you understand your borrowing capacity. In general, the banks will lend you 5 to 6 times your income. So, if you're earning $100,000 per annum, you'd expect to be able to lend between $500,000 and $600,000. But that can change drastically depending on the type of income you're earning, if you're single or in a relationship, what your liabilities and monthly expenditure is, and so on and so forth. Ideally, a mortgage broker can calculate your borrowing power based on all these factors, and in this way, we'll be able to understand your exact capacity. Essentially, the more income you earn, the less you spend, the more you'll ultimately be able to lend. And whilst these are only 3 things, the next time you're shopping for a home loan, you can understand that rate isn't always the most important factor. And when considering your options, there's much more to the puzzle than meets the eye. Thanks for making it all the way to the end. Please like and subscribe. And for our next video, I'd love to understand what you'd like me to cover. So please leave a comment below. Thanks and catch you next time.